So, hello everyone. I firstly would like to thank everyone of you to take out time and join the webinar. So, let me introduce myself. I am Pramit Shah, Manager Partnership and Alliances at altGraaf. I'm part of five-member team of Partnership and Alliances. And along with me, we have Sonal Parekh, Head Customer Relations, and Jay Prakash, Chief Growth Officer at AI. So, as all of you know, altGraaf is the first horizontal fixed income investment platform in India. And our aim is to assist individual investors in earning better returns by participating in fixed income opportunities exclusively curated by us. At altGraaf, we offer product ranges starting from commercial paper, inward discounting, corporate debt, asset leasing, and venture debt. And today we are glad to announce that we are evolving and we are delighted to launch our 5 new product offerings in inward discounting category with a new faceover. So first, let me tell you what is inward discounting. So inward discount is basically a short-term financing for working capital requirement of small to large enterprise against their unpaid invoices. Basically, funding requirement happens after post-sales when invoices are raised by vendor towards the buyer. And it typically carries a duration of 1 to 3 months. So this is basically a concept of inward discounting is. Okay. So what I'll do now, I'll brief you the 5 different products which we are introducing in just one line. Yeah, fine. So first is the All Smart. So All Smart is basically a inward discounting which is backed by a 100% backed by a bank guarantee. Secondly, All Armor, which is a backed by trade credit insurance. Third one is All Blue, where the invoices are raised by an established company with a trade credit insurance. Then AltPack, it's a kind of a we everybody must have invested in a mutual fund portfolio, okay, which carries a fund which is carrying a portfolio of 15 to 20 companies. Same way, it is a pool of invoices from a triple and double A rated company. And lastly, which is a Alt Wings, which is our regular product, which I hope everybody out of you must have invested on our platform in this Alt Wings. So the merits of investing in this category for the investor are this: products comes with a very short tenure and a gold rates as compared to the other products which are available in the market. Okay. This product comes with a fixed returns and it has nothing to do with any kind of market volatility, not equity, not a debt market. Here the products which carries a fixed maturity products means you from the day one you know what amount you are getting on and on which day you will be getting. You don't need to do any kind of withdrawal request or not initiate any kind of a redemption or a portal. Okay. Both the secured and unsecured products options available as with your risk appetite, and you can diversify your portfolio beyond the traditional products available in the debt and equity markets. So this is something from my side, and I'll ask Sonal to take the session forward.
Thanks, Pramit. Good evening. Welcome everyone to this webinar session on the newly launched products on the altGraaf platform. So I will now take you ahead with explaining a little bit more about each of the products that we've introduced today on the platform. So let's talk about AllSmart. Now, this is an investment which is 100% secured by a bank guarantee, and all repayments are made through a controlled escrow account. Now, how does this work? I mean, this is a lot of statements in a sentence. So how does it actually work is something that I'll put together as simply as possible for all our participants to understand it. So here is the situation, which is the transaction flow for AllSmart. Who are the parties involved? There is a seller, there is a buyer, there is altGraaf, there are the investors, and then there is a bank. Now what happens is, now what is a bank guarantee? Let's understand first what is a bank guarantee. So a bank guarantee is an enforceable commitment by a bank to ensure a payment to its beneficiary. So the issued BG can be invoked, and on a failure of a payment, can be paid out to its beneficiary. That is what is a bank guarantee. Now, what happens is the seller sells its goods and services to the buyer, and then an invoice is raised. Upon that, a bank guarantee is issued in the favor of the seller by the buyer's bank. I hope it's clear until now. So a bank guarantee is issued by the buyer's bank and in the favor of the seller. Now what happens is that altGraaf lists this opportunity on the platform. Investors come, investors participate in the opportunity, and then the funds are sent to the seller. Now, on the day of the due date, the buyer is supposed to make the repayment to the escrow account directly controlled by altGraaf. So here what happens is the buyer does not make the payment to the seller. It makes the payment directly into an escrow account, which is controlled by the altGraaf. That is the most important function and criteria I would say here is. So it comes into the escrow account and then it is distributed among the investors. Now, in case there is a default or a delay, there is a default, we will consider, if there is a default in a payment, then what happens is that the bank guarantee for which the seller has already assigned the bank guarantee to altGraaf then invokes the bank guarantee, and the payment is made into the escrow account and then paid to the investors post 20 working days from the scheduled date of repayment. That's when we initiate the invoking of the bank guarantee. And then it takes typically 5 business days to receive the payment from the bank in case there is a default. So what we learned till now, that there is a bank, the buyer's bank, that issues the bank guarantee in favor of the seller. Seller then assigns the bank guarantee in the favor of altGraaf. The opportunity gets listed on the platform, and in a best case scenario, buyer makes the payment directly into the escrow account. If there is a default, after 20 days, altGraaf initiates the process of invoking the bank guarantee, and it takes typically 5 business days to receive the payment in case there is a default. Now here, the best part is that you can earn a returns of 10 to 11% in this AltSmart. So hope I was able to clarify this. We'll move on to altArmor. So what is altArmor? This is an investment which is protected by trade credit insurance. Now, trade credit insurance backed invoice discounting, this also has an escrow control. So there is an insurance limit that will cover 100% of the principal plus interest, and the returns would be somewhere between 11 to 12%. The risk to be noted is the same as altSmart, will be very low and low. So what are the highlights of an altArmor invoice discounting opportunity that is listed on the platform? So this is secured by a trade credit insurance that is availed for buyers to whom invoices are raised. This covers the investment amount plus the interest. altGraaf controls the escrow where the repayments are received by the buyer. So trade credit insurance. So what exactly here is? Here also, all the more very similar parties involved, just like altSmart. Here there is a seller, there is a buyer, there is a third-party insurer, there is altGraaf, and then there are investors, and there is an escrow account controlled by altGraaf. Here also what happens is the seller sells its goods and services to the buyer, and then there is an invoice which is generated upon it. Then seller goes ahead and gets an insurance of from a third party for a trade credit insurance, and it gives you a certain limit. So here an interesting thing that also brings us to the fact that both the bank and the insurer does a credit assessment of the buyer before giving any insurance limit or even if it's a bank guarantee. So the important aspect to look here is that whether it is a bank guarantee or whether it is an insurance, they do a credit assessment of the buyer and then they provide with an insurance on the same. So how it works is that the insurance company assesses the buyer's ability to repay its obligation and then approves a limit on it. Then investors on the altGraaf platform buy these invoices and the buyer makes the payment on the agreed schedule again to the escrow account, which is controlled by altGraaf, not to the seller, but directly to the escrow account. And then it is repaid to the investors. Now, let's say if there is in case of a default, so what will happen is seller will initiate a claim process, and then once the claim is settled, point to be noted again here is that all insurance claims also will be settled directly into the altGraaf escrow account, not the fact that it will go into the seller's own account, but even if the insurance is claimed successfully taken out, it will go directly into the escrow account. So that's the layer of protection that has been covered here, that there is an insurance protection which includes 100% of the principal and the interest, plus all the claims go into the escrow account. So hope that was clarified. We'll obviously, take questions at the end of the seminar. So if you feel you have a question at this point, please do write on the Q&A section and we'll be happy to take it up with you. Now, next one is altBlue. Now in altBlue, we have basically the idea of altBlue comes from the fact that these invoices are raised by blue chip or established corporations. So all repayments are again made into the controlled escrow account. So here we will have two scenarios in which altBlue would operate. The IRR would be anywhere between 11 to 12.5 and the risk would be in medium. So we'll talk about the first scenario in altBlue where there is a trade credit insurance. It is very similar, I would say very, very similar to what we discussed in altArmor. But here we have taken an insurance coverage of 90% of the principal. So here the investment, we will call it as partially secured, whereas in the previous ones, we saw that it was the investment principal amount plus interest amount was secured in that. Here you have an insurance cover of 90% of the principal. Same thing happens here. The seller delivers the goods to the buyer and then an invoice is generated. Then seller gets a trade credit insurance on the invoices, and opportunity is listed on the altGraaf platform. Investors participate. On the day of the payment, buyer again makes the payment directly into the escrow account. In case there is a default, there is we'll talk about the risk also here. There is a 10% risk of principal, which means 90% of the principal is insured. We also would want to talk about how the claim settlement process works here. In the event of a delay or default in repayments, seller initiates the process of filing the insurance claim within 90 days of the default. And claim settlement process, as we all know, do take time. It may take up to 3 to 6 months in processing or longer, depending on case to case. It could be lesser, it could be slightly longer, but claims do take that much time that we might have all experienced some time or the other. All insurance claims again will be settled directly into the altGraaf controlled escrow account. So moving on, then we have another scenario in altBlue where there would not be any insurance backing or not even a bank guarantee. Here what will happen is there is a large corporation through which the seller delivers goods to. The buyer is a very large corporation. It invoices get generated, and here also we have the same arrangement that the funds on the day of the repayment will go into the escrow account. This investment will be unsecured, but to note here is that these will be large corporations which you might want to read upon, which we will further list on our platform, where you'll see big names. We will have some examples on our website where you'll see names of established corporations to which the invoices will be in favor of, and these large corporations will agree to make the repayment on the escrow account, which is controlled by altGraaf. This will give you a slightly higher yield as compared to the previous one that we discussed. So that's all about altBlue. Then we have our altWings. This is where you invest in established and upcoming companies across varied industries and sectors. People who've been with us, I do see a overwhelming participation today. Must be aware, we've worked across sectors, and we've brought a variety of sectors onto our platform, and there have been vendors who've been with us for a very long time. So the IRR that you will earn here is 12 to 14%. The risk will be high to very high, depending on the credit worthiness of each borrower as well here. So the transaction flow for this will be different from what we just discussed. Here there is a seller that sells the goods and services to the buyer, and the invoices are raised on the same. Then what happens is the opportunity gets listed, investors come and participate in the opportunity. And on the day of the repayment, what distinguishes this from all the others that we discussed is the buyer will make the repayment to the seller, and the seller will then distribute the payment into a regular collection escrow account, and then the distribution will happen to the investors. This investment is unsecured. There is anchor does not pay into an escrow which is controlled by altGraaf, and seller transfers the proceeds into a regular collection escrow account. So here there is a commingling risk that exists, that the buyer is not making the payment directly into the escrow account, but he's making the payment to the seller, and then the seller makes the payment into the escrow. So this is all about our alt swing product. Now we'll talk about the alt pack, and if JP would be taking this up.
Yeah, I think thanks, Sonal. Good evening, everyone. Right, I'll talk about this alt pack, and I'll also summarize some of the things that Sonal kind of covered in the other products. Right, in alt pack, the concept here is the investor is investing against a pool of receivables, and this pool of receivables will not be from, say, one buyer or one seller. There will be a party called originator who's not actually selling goods or buying goods. This party originator's primary responsibility is to assemble the sellers and buyers. So they will try to get hold of multiple sellers who are selling goods to multiple buyers. And he's collecting invoices across the sellers, across these buyers, and creating a pool. That pool, or a basket you can call it, is going to fit some specific criteria. It could have some criteria specific to, okay, these invoices have to be from e-commerce companies, or have to be invoices itself, or it has to be from AAA companies, AA companies, triple B, triple minus. So the pool that is going to be created that meets that criteria could be anywhere, anything, right? So that pool itself can have different type of risk. It can be very, very low risk, or it can be very high risk as well. But the primary aspect here is the originator is creating this big basket from different sellers and buyers, thereby actually creating an opportunity for the investors with respect to diversification, right? So he creates that basket, and through a special purpose vehicle, he creates something called an instrument called PTCR, pass-through certificates, right? These pass-through certificates, actually, when you invest, it will come in your demat account. And through this special purpose vehicle, there is a trustee appointed, who is a SEBI registered trustee appointed. He overlooks to make sure that the basket is meeting all the criteria that is set forth by the originator. There is an escrow that will also be under the control from a trustee standpoint. Similar to what we discussed before, same thing happens, right? Since it's a basket, there's a special purpose vehicle entity through a trustee who's managing the escrow. Trustee makes sure the basket is meeting the criteria that originator told. The originator, all he does would be is create these instruments, and through altGraaf, we sell these instruments to the investors. So investors buy these units of PTCs, and when the due date comes, the buyer pays for all the invoices, and all the money from the buyers are all coming to an escrow account, which is under the purview of the trustee. From there, it goes to the investors. In this particular aspect, the main 2-3 things we need to think about, right? One is the fact is the pool that I talked about, the basket I talked about, is a variety of invoices, right? I think that gives a lot of diversification for the investor who's investing in it. Second part about LD is it is an instrument which requires a demat account. It's going to go into your demat account, like a bond, a mutual fund, anything. It will go to your demat account. And there is a trustee appointed by SEBI, a SEBI registered trustee who's overlooking if the pool is managed, escrow is there. On top of it, in this product, at least on the platform that we have now, the originator also is provided a 15% protection on principal. What it means is if in case the buyer is not paying on time, for example, up to 15% of the initial losses would be covered by the originator. So it's a partially secured, but there are instances when the originator might not give any security in terms of the principal, where 100% would be borne by the investors. In this case, at least the deal that we have on the platform has a 15% protection, which means 85% is borne by the investor. The pool basket that we talked about in the platform that we have now are all from AAA and AA invoices. So the risk is relatively very, very low. So your yields will change. So the risk of this particular instrument can go all the way from very low risk, can be up to high risk, and your yields will change depending on what the pool is and also the consideration that I told you about the 15% protection coverage that the originator is giving. It depends on that, right? So that's pretty much an alt package. It's a demat account is required for this particular investment compared to the other products, but otherwise it is a little bit different structure per se. But I think it's also a good measure from a standpoint. If you think about all these different products, all these products were meant to give you a choice from the lowest risk to high risk. All of them have different type of structures, have different ways of operations. The whole aspect of from altGraaf side is to make sure that the customers have choices and they have an ability to kind of mix and match how they want to fit in. I think that's the primary purpose of trying to have different structures to meet the needs of the customers. With that said, we can go to the next slide. So let me spend some time on the risks. We talked about the 5 products, right? So the first product we talked about is the Alt Smart, is an invoice discounting solution with bank guarantee. Then we talked about the Alt Armor, similar protection, but instead of a bank guarantee, is an insurance protection, both as escrow controls. Then we have the Alt Blue on established companies with some insurance with escrow control. Alt Pack, which is the basket we talked about, as escrow control with some protection. And then we have the Alt Wings, which has no security like bank guarantee or insurance, and there's also no escrow control tied to it. Invoice discounting as a product category is an unsecured product. Whether it's a credit risk, we have 3 types of risk. The credit risk is the inability of the person. In the case of other products that we talked about, the inability of the person who actually got the goods, and at the time of due date, the person who's supposed to pay is not able to pay. The credit risk always there. Liquidity risk is always there because you're investing. After some time, you're getting the money. After 7 days, you want to change your mind, you want to get the investment. There is no party to buy it, so the liquidity risk is there. And there are instances where other things a fraud can also have. And then similarly, I think 2 products we talked about, the bank guarantee and the trade credit. Bank guarantee, the risk is very low, but all investments carry risk, and I'll never be in a position to say it is 100% guarantee, right? So the bank guarantee has a guarantee document with a number to say that the interest and principal is there. In the instance, and the worst case situation happens, and the buyer is not able to pay, a bank guarantee is invoked. There could be sometimes risk with bank guarantee as well. What if the bank itself doesn't exist anymore? So that bank risk is there, right? What if there are instances where there is a fraud committed? So then the bank would decline to do the payment because there was a fraud case, or sometimes operational risk can exist. Similarly, insurance, you all are aware of insurances. Insurances have policies. Sometimes the settlement might not be, while the insurance coverage, for example, in Alt Armor is 100% of principal and interest. And normally it happens, but there can be instances where they might settle for a lower amount than what the full amount insurance is. The claim period is long on insurance. I mean, you're all aware of insurance policies. When we put it immediately, they don't approve it. So the claim period past the repayment date could be longer. Sometimes exclusion could be there. So there are few risks that are there, but relatively they're all very low risk, primarily because that coverage is there, and majority of the time they do make, but there are instances where the risks do exist, right? So with that said, I hope I covered some of the things, but one of the important things would be risk mitigants are taken in all these different cases, right? For example, in a bank guarantee, Alt Smart, as I told you, normally bank guarantee itself is coming as a risk mitigant. Escrow account is coming as a risk mitigant. On top of it, some of the cases we take undated posted checks or PDCs or UDCs on the companies. If there is a parent company, we might take corporate guarantees on group companies. So we take protection measures. Similarly, in insurance is there, escrow is there. On top of it, UDC, which is undated checks, posted checks is there. If there's parent, sometimes CG is there. In unsecured products like Alt Wing, where there is no bank guarantee, there is no insurance. Definitely, there is no security as per se given by a bank or insurance. So in those cases, the options, the customer is kind of investing with completely unsecured. In worst case situations, these risk mitigation measures like UDC, PDC, sometimes CG, if there is a group entity, will be leveraged to minimize the effect or minimize probably the risks that the investor might, it will probably be a mitigant for the company to default on payments. But if it happens, default happens, then there is always aspect of legal proceedings and everything. But on paper, you cannot call it as anything, no securities like a bank guarantee or insurance standpoint. So that's a risk the investor has to take with respect to worst case situations happen, and that is always going to be there with invoice discounting, especially when we don't have a BG or insurance component. Okay, I'm going to summarize. I know we covered quite a bit, so I'll try to go very slow. After that, I will try to answer as many questions as possible. The first product we talked about is the Alt Smart Bank Guarantee. The primary aspect of how it works would be, as Sonal was talking earlier, all the invoices that the investor is investing on is covered by a bank guarantee. The bank guarantee is for the amount equal to or more of principal and interest. In the end, when the payment comes, the buyer makes a payment to altGraaf controlled escrow account, and from the escrow account, it goes to the customers. In worst case scenario, where the buyer is not able to pay, altGraaf has an ability to invoke the BG. BGs are very quick, which means after repayment due date, if the payment is not made, we'll probably wait for about 20 business days, invoke it, and once we invoke within 5-6 days, the BG money will come. So it's a very, very quick process. So that is one of the reasons we call it as very, very low risk because of the speed as well. And when you think about this, think about the fact that the bank who is giving the guarantee is doing so because they're comfortable with the buyers paying on time. They know that worst case situation could happen, but they feel that they're able to make money regularly and they're feeling comfortable with past history of transactions from the buyer. And they feel like, okay, I'm making good, decent revenue with respect to giving this bank guarantees, and I'm very comfortable with the buyer. Yes, some bad cases could happen. When that happens, I have no problem giving the money. I think that's how the bank thought process is. So that's that particular product. Here, there is no insurance. In this case, as I said, entire 100% of principal and interest is secured by the BG. Escrow control, which is directly managed by altGraaf, which means the buyer pays, it comes. So that's the reason it's very low risk. The yields obviously would be a little lower in this case because of the risk standpoint of it. There's no DMAT, there's no trustee on this. Then we talked about the Alt Armor. Alt Armor is purely insurance, and the insurance coverage that has been bought on the invoices on which customers are investing is 100% of principal and interest. That's the amount of coverage we have bought, the seller would have bought on the invoices, and the investors are investing against it. It can be called secured or can be called partial secured. Sometimes conservatively use partial secured. Why? Because there's always the option of what if the insurance company approves amount a little bit lower than the full 100% principal and interest. So sometimes we use that partial, but if you think about how much we are taking cover for, it is the entire 100% principal and interest. Escrow control, similar, buyer pays back, it comes to an escrow account controlled by altGraaf. From there, it goes to the customers. Tenor is again up to 90 days normally. The yield will be little bit higher than BG. Risk is also, as I told you, is relatively very low in this particular time. altBlue, we have got two variations of altBlue, one with insurance, one without insurance. altBlue is pretty much what it tells is that you are investing against invoices on established companies. Established companies, what I mean by that, normally they are very big, at least multiple thousand crores in terms of top line, multiple years of profitability, and they are very well-known brands. Sometimes you might know, somebody not know, but they're all very big companies who are, a lot of them might be also listed. So which gives a lot of comfort level. That is the reason the insurance, sometimes when we buy, that's been bought, sometimes is lower. Like if you talk about Alt Armor, we have taken the insurance on the entire principal and interest. Here, it's just 90% of the principal alone. The more the insurance we buy, the more the cost, which means the returns to the customer would be a little bit lower. I think that's the variation part that comes in there. Escrow control is there, and then payments come to buyer. Buyer goes to altGraaf control escrow account and goes back. And then same concept of altBlue without insurance. The only thing is escrow control is there, but there's no insurance, so we call it unsecured. We can't call it anything else because there's no BG or the bank guarantee or the insurance component there. And the alt wings, there is no insurance, there is no BG, and we do not have control on the escrow account. They might have an escrow account probably managed by a bank, these companies, a lot of these early stage companies, mid stage companies who have a lot of banks in their debt, who have given borrowed debt from banks and everything. Sometimes we will not be able to establish escrow control. It will be escrow control will be owned by the banks. So there we will not be having an escrow control, which means when the buyer pays back, it goes back to the seller's escrow control account, which could be managed by banks, as I told you before. And from there, the money comes to us, and then we comes through us through a collection account, and from collection it goes to the investor. So in this case, there is no escrow, there is no BG, there is no insurance. So the risk is high or very high, depending on it. And the yields also will be on the higher side of it. Sometimes it's 14, sometimes it's going to go a little bit higher as well. Sometimes the 12.5 range as well. altPack I talked to you about. It's an instrument which is going to be listed in the demat account. It is, we call it pass-through certificates, a pool or basket of receivables. Escrow account would be there. Sometimes there is going to be a credit risk protection, limited credit risk protection that can be there. And the risk can vary depending on the pool of invoices. I think I hope I think I was able to summarize and kind of cover one more time after what Sonal has done, and I've covered this. Okay, I think we are past 10 minutes past 6. I think I appreciate a lot of questions. I think I went very fast trying to answer as many as possible. As I indicated, we will do more conversations. As you kind of look into it, you will probably have more questions. We will have more conversations at a future point in time as well. So you can come and then get those questions answered, or you can reach out to Relationship Manager website as well. Again, thanks for taking all the time, Sonal and Pramit. We can wrap this. I appreciate everyone taking the time.
Thank you. Thank you everyone for taking the time out.